the world of these theories which help us understand theoretically what is the optimal capital structure. Now, before I get into these three theories, I would like to actually give you a high level overview so that when you actually go into the details, you don't get that confused. Right? So, Modigliani and Miller first came up with the 1958 theory. Then in 1963, they updated it, and then what we have is the static trade-off theory. Now, what's the difference between these three? First of all, in the 1958 one, this one assumes no taxes. This one is with taxes. And the third one is with taxes as well as with cost of financial distress. Now, what does this mean? First of all, in the first one, as you increase debt in a capital structure, so as your debt to equity ratio goes up, what Modigliani and Miller said is that, hey, your cost of debt stays the same, but your cost of equity keeps going up as you increase debt in your capital structure. And so it actually looks somewhere like something like this. Let's say the cost of debt is 5%, cost of equity is 10%. When there's zero debt, but as you increase debt, it keeps going up. And why it goes up is because you're increasing the financial risk in the business, right? As we increase debt in a capital structure, what happens is that you're taking on this contractual, the company is taking on this contractual liability where they have to pay interest whether or not the profit is there, whether or not the sales is there, right? And the equity holders find it risky because if the assets go down, if the business is not doing well and the assets go down, well, they are going to have to take the hit for that. So that's why they ask for higher and higher return, right? And even though you are adding onto a cheap source of capital, you're increasing the weight of debt. So the weighted average cost of capital should go down, keeping in mind that it's a lower component of cost of capital that you're increasing the weight of. But because even though the weight of equity is going down, but the cost of equity is going up, so the impact on weighted average cost of capital is not there. Basically, the weighted average cost of capital does not change. But keep in mind that this was without taxes. Now, what happens in their own theory, they updated in 1963, they said, hey, we made a mistake. The cost of debt doesn't change, right? The cost of equity goes up, but as you increase your debt, there is not only that you add a cheap or a low cost component into your weight, but there is also a tax benefit. And you know that the cost of debt has something which is 1 minus the tax rate that we multiply it with, because it is a tax deductible expense. And that's why what they're basically saying is that your weighted average cost of capital actually comes down. It comes down instead of staying flat. But then later on, what we have is the static trade-off theory, which says, okay, this is also with taxes. So it does say as you increase the debt, your weighted average cost of capital does come down. But then there is something called cost of financial distress, which means let's say COVID lockdown is there, your sales is not coming, your profit is bad, right? You're in a loss and you go bankrupt because interest payments have to be made and you can't make them and you go bankrupt. And there's a cost associated with that bankruptcy called cost of financial distress, which means that you lose business, right? Because you won't be continuing as a business, as a company. So all the opportunities you will lose, and even if you have to restart, there will be a certain bankruptcy cost that you have to face. So there is a cost of financial distress, and the present value of that cost becomes more than the tax benefit at some point, right? So before this point, the tax benefit value is more. After this point, the present value of the financial distress is more, and the WACC starts going up. So the WACC does come down as you include more and more debt in the capital structure, but then it starts going up. And this is obviously the optimal capital structure. So this is the high level introduction to these three theories, right? But Modigliani and Miller have two propositions for each of these. So there's proposition 1 and there's proposition 2 in each of the theories. The one which we just discussed is proposition 2 for each of them, which basically says that WACC does not change and WACC changes. That is your proposition 2. Proposition 1 is regarding the value of the firm. So in the first one, it says the value of the firm with debt is equal to the value of the firm without debt. And how do they say it? They call it the value of the firm which is with debt as the value of the leveraged firm, and the value of the unleveraged firm is the same because their weighted average cost of capital is the same. But in the second one, with taxes, what we say in proposition 1 is that the value of the leveraged firm is actually greater than the value of the unleveraged firm. Why? Because there is a tax benefit. So the value of the leveraged firm is equal to the value of the unleveraged firm plus the tax benefit, right? So the tax rate into the debt amount. This is the tax benefit that you get, and hence the value of the leveraged firm is greater. But in the static trade-off theory, we basically say that the value of the leveraged firm is the value of the unleveraged firm plus the tax benefit, right? But minus the present value of the cost of financial distress. So this is the high level discussion of this entire three theories that we will talk about. If you want, you can rewind this video again, watch this whole discussion, and then get on with the filling in of the color in the different parts. Right. So what did Modigliani and Miller say in terms of their assumptions? Some very, very theoretical assumptions, not very practical, but nevertheless, they gave us a starting point into understanding the capital structure and how you can move towards a theoretically optimal capital structure. So what are their assumptions? Number one, homogeneous expectations, that all investors, whether they are coming into equity or debt, have similar or same expectations. Secondly, capital markets are efficient, they are perfect, there's no transaction costs, no taxes, right? No bankruptcy costs, everyone has the same information. Risk-free rate, anyone can borrow or lend at the risk-free rate. No agency costs, which means managers will always act in the best interest of their shareholders. All of these assumptions are not very practical. Independent decisions, that your capital investment decisions are independent of your capital structure, meaning that what you do with the money is different than where you're getting that money from. And this, as inefficient or impractical as it might be, it does provide us a starting point into the optimizing of a capital structure, and which we do, right? So we will move on to their second theory, and then we will move on to the static trade-off theory, and then towards the end of this learning module we bring in some more practical considerations, but at least this is a starting point for us. So now with their first one, which is the 1958 without taxes, and the first proposition of the first one, which basically says, hey, the value of the levered form is equal to the value of the unlevered form, right? Because there's basically no reduction in your weighted average cost of capital, right? Even though the cost of debt is lower, but the cost of equity goes up, and therefore the impact on your weighted average cost of capital is offset by the increase in the cost of equity, which increases in a linear fashion. So it's exactly offsetting. As your debt to equity ratio is going up, similarly your cost of equity is going up in a linear fashion. So it just offsets that benefit from including the lower component cost of capital, and your weighted average cost of capital doesn't change. Therefore the value of your leveraged form is equal to the value of your unleveraged form, right? And that's what is here in the VAC. As you can see that the 1 minus tax is not there, right? The 1 minus tax is not there. They're saying whatever is the cash flow of your capital investments, right, that is what decides what is the value of the firm, not the discount rate, because the discount rate doesn't change. Because even if you increase the weight of debt, right, and that brings in a lower cost component, but the weight of equity goes down, but the rate of equity goes up, and it just kind of balances out completely because it's in a linear fashion. And they have explained this in terms of a pie, and let me show you, right, that no matter how you cut this, the value of the firm, so this is the value of the levered firm or the value of the unlevered firm versus the value of the more levered firm. As debt is going up, right, it just stays the same. It doesn't matter that how much you increase the leverage. So this is also leveraged, this is also leveraged, but obviously this is leveraged more. But no matter how much you increase it, the value of the firm is not changing. And that is what they are saying. Why? Because the cost of equity or the return on equity goes up in a linear fashion. So as you increase the debt to equity, the cost of equity or the return on equity goes up at a 45-degree angle, right? So this is, let's say, your cost of equity when you started with zero debt. As you increase debt, what will happen is that there will be a difference in the cost of debt and where you started from, and you will get that benefit, right, because you're increasing the weight of debt. So you are getting a lower cost of capital component to come into financing the assets, but the cost of equity goes up with that exact difference and the exact amount of the weight that you are increasing of debt to equity. So it just cancels and your WACC stays the same. So that is where your proposition 2 comes in, that WACC remains constant. Right, and a very nice diagram over here that your WACC remains constant. It's probably a much better drawing than the ones I have been making. Now guys, with proposition number 2, the theory number 2, Modigliani and Miller, 1963, they included taxes, and now they're saying that, okay, so your cost of debt is lower, your cost of equity does go up, but your WACC actually comes down because there is tax benefit as we take on more and more debt. And therefore, the value of the leveraged firm is greater than the value of the unleveraged firm. And how much greater? Well, the value of the leveraged firm is the value of the unleveraged firm plus the tax benefit, which is the tax rate multiplied by the debt amount, the dollar amount that you have taken, right? And therefore, even though your equity is going up, the cost of equity that you have is going up, right? But not at a 45-degree angle, at a less than 45-degree angle, because it is reduced by the tax benefit. So that's why what happens to your WACC is that it smooths and kind of slides down which means that obviously the value of the unleveraged is not going to be equal to the value of the leveraged because of that tax benefit. But this is obviously not correct as well, because what you're saying is as much debt as you can take is good for the business. Even 100% is optimal, which makes absolutely no sense. Imagine if a company has 100% of their assets financed with debt at 0% equity. Even if there is a 1% fall in the assets, who's going to take that hit? If there's no equity, then the bank will have to take that hit, right? And the bank is obviously not providing that type of capital. So this is not practical. And the company will go bankrupt at the first loss that happens. That's why we have to take into account something called the cost of financial distress, which says, hey, as you increase your debt to equity ratio, you're increasing the risk of bankruptcy. So, yes, your WACC might come down, but then it will start going up again, because after a certain point, the present value of the cost of financial distress will be greater than the tax benefit. Right? And what is the cost of financial distress? Can be categorized into two: direct and indirect. Now, direct is the costs associated with the actual bankruptcy, legal and administrative fees. But then there are indirect costs that you lose business, the investment opportunity is foregone, the impaired ability to conduct business, agency costs, right? People will obviously then prioritize their interests, your employees, your suppliers, customers, everybody is going to then not be happy with the situation. So that's something we have to take into account. It's not the same for everybody. So businesses that have a ready market for, or ready secondary market for their assets, such as airlines, shipping companies, they will have relatively less cost of financial distress. Other companies which have everything which is related to their goodwill, such as Airbnb, right, or Uber, and once they, or things like WhatsApp, right? I mean, once they lose their network, then it's very hard to regain that network. So there is a very serious cost associated with financial distress. So as you increase the financial leverage, the risk of bankruptcy goes up, the probability of bankruptcy goes up, because there's less equity to absorb any losses, and therefore the cost of financial distress goes up, right? You also have to see what are other factors, and we will talk about this later, that sometimes increasing debt actually is beneficial for the company, because it keeps a check and balance on the management, since they have to keep paying interest, so they cannot play around with the money and take private jets for management meetings. But we'll talk about that later. Overall, as debt increases, the financial risk increases, which means the risk of bankruptcy goes up. Right. So far in the propositions, we only relax the assumption of no corporate taxes, but now we are going to bring in the cost of bankruptcy and financial distress. And that is where we get to the world of the static trade-off theory, right? Which basically means that the value of the leveraged firm is equal to the value of the unleveraged firm plus the tax benefit minus the present value of the cost of financial distress. And therefore, we say that, okay, WACC will come down, but then it will start going up once the tax benefits are not as much as the value of the financial distress. So at some point, the present value of the financial distress will equal the tax benefit, and then they will outweigh them. And that is where the firm value starts going down. So the firm value is maximized when your WACC is minimized. So if I draw sort of a parallel over here, and this is your WACC, as you increase your debt to equity ratio, the WACC is minimized somewhere over here, and that is where the value of your firm is maximized. But then as your WACC starts going up, the value of your firm will start coming down. sorry, this is the value of your firm, right? That starts coming down from this point onwards. And why is that? Initially, it's going up because you are getting that tax benefit, and tax benefit is greater than the cost of financial distress. But then the cost of financial distress starts catching up with you, and the value of your firm starts going down. And what's really important to understand is how it gets coincided with where your WACC is on its lowest point, right? That is the maximum value of your firm. So this is going to be the max value of firm, where your WACC is lowest, where your WACC is passing through its lowest point. Right. So is this practically correct? No, this is theoretically correct, right? Practically, there are a lot of other things which you need to take into account. And like, for example, Amazon issued debt because it was cheap to do it, right? Sometimes share prices are so high, it might actually make sense for a company to issue shares because it's just easy to sell it at that high price, right? So that's why companies might use different structures than the optimal one. And what even is the optimal one? Nobody even knows, right? So we say somewhere between 30 and 50. Okay, I think let's take a break over here, and then we will come back and talk about market value and book value.